Welcome to the 5th class of our Introduction to Financial Markets course. In this session, we kick off the second module, where we will dive into fundamental analysis and macroeconomics. This module is essential for understanding how financial markets behave and how economic variables influence our investment decisions. If you're looking for a deeper understanding of how changes in the economy affect your investments and how to analyze a company's value, stay with us. Remember to subscribe and activate the notification bell so you don't miss any classes. Disclaimer: the content of this channel is for educational and informational purposes only. It should not be considered financial advice, investment recommendations, or an invitation to engage in trading in financial markets. Always conduct your own research and consult with a financial professional before making any investment decisions. Investments carry risks, and we do not guarantee any specific outcomes. If you're ready, let's get started. The economic cycle and its impact on markets. To start, let's talk about the economic cycle, which is the foundation for understanding how the economy regulates itself. This cycle has two main phases. Economic expansion. In this phase, gross domestic product, GDP, grows, more jobs are created, and wages increase. This stimulates consumption and investment, leading to overall economic growth. However, as wages rise, labor costs for companies also increase. Eventually, this makes hiring more expensive, causing companies to slow their expansion. Economic contraction. When economic activity slows down, GDP decreases, as do employment and wages. This leads to a reduction in consumption and investment. Although this phase may seem negative, it is a natural part of the cycle, allowing for corrections of excesses and paving the way for a new expansion. Why is it important to understand this cycle? Because different phases affect each type of asset and economic sector differently, influencing investment decision-making. Identifying which phase the economy is in helps us adjust our strategies and choose the best opportunities. The major financial markets and their role in investment. To adequately distribute our assets, known as asset allocation, we must understand the three main markets. Money market. This market includes the most liquid assets, such as promissory notes, treasury bills, and certificates of deposit, all with short maturities, typically less than 15 months. This market is ideal for investors looking for a safe place to park their money short-term, with lower risks but also lower returns. Fixed income market. This market includes debt issuance by governments and large corporations. Debt securities such as bonds and debentures offer regular payments over a defined term, known as the coupon. This is why it is called fixed income, because the payments are predictable. It is an option for those seeking stability and a fixed income, although in exchange for limited growth. Equity market. Here we talk about stocks, which represent ownership in a company. Unlike fixed income, stock dividends can vary, and the stock price is more volatile, meaning its value can rise or fall significantly. Although this market carries more risks, it offers greater long-term return potential through capital appreciation and dividends. How to decide in which market to invest? It will depend on your risk tolerance, investment goals, and time horizon. Comparing fixed income and equity. Let's expand a bit more on the comparison between fixed income and equity. Fixed income. It is characterized by having a known maturity, periodic payments, and generally a lower level of risk. Investors who buy bonds are lenders to the issuing entities. Therefore, it is known when interest will be received and when the initial capital will be recovered. It is ideal for those seeking stability in their cash flows and lower exposure to market volatility. Equity. Investing in stocks means becoming a part owner of the company. There is no fixed maturity, and returns depend on the company's performance and market conditions. Profits may come from stock appreciation or dividends. However, due to their unpredictability, prices can be uncertain and volatile. This makes equity investments attractive for those with a higher risk profile seeking greater long-term returns. Macroeconomic analysis. A look at the global economy. Macroeconomic analysis is crucial for understanding how global factors influence markets. We study variables such as public deficit, debt, inflation, interest rates, and unemployment. For example, if inflation rises, Central banks usually increase interest rates to control price hikes. This can make bonds more attractive because they offer higher rates, but it can negatively affect the stock market. Knowing which phase of the economic cycle we are in helps us adjust our strategy and decide which sectors and assets to focus on. Fundamental analysis. Evaluating a company's true value. Fundamental analysis seeks to identify the intrinsic value of a stock based on the company's financial results and growth prospects. Key tools include financial statements, such as the balance sheet, income statement, and cash flow statement, which provide a clear view of the company's financial health. Valuation techniques, such as discounted cash flow and market multiples, which allow us to calculate how much a stock should be worth based on its future earnings. Economic forecasts. Analyzing how changes in the economy can impact the company's results and the sector in which it operates. Fundamental analysis is ideal for long-term investors looking to identify undervalued companies in the market. Technical analysis. Deciding the best time to invest. Technical analysis helps us identify patterns and trends in asset price behavior. It is based on three aspects: price or quotation. The historical price of an asset gives us clues about its future trend. Transaction volume. Analyzing volume shows the strength behind a price trend. Open interest. This is the number of open contracts at the end of a period and can indicate market interest in an asset. Technical analysis is useful for traders and those looking to capitalize on short-term market movements. Bottom-up and top-down strategies. Finally, let's talk about two approaches to choosing investments. Bottom-up approach focuses first on finding companies with good growth prospects, then analyzes the sector, and finally the macroeconomic environment. It is useful for identifying specific opportunities without being overly concerned with the global landscape. Top-down approach begins with an analysis of the global economy, then focuses on sectors that may benefit, and finally chooses the most attractive companies within those sectors. It is ideal for those looking to capitalize on macroeconomic and sectoral trends. Conclusion. Which analysis is better? The choice of analysis depends on the investment time horizon. For short-term, trading and technical analysis are more relevant. For long-term, the company's solvency and fundamental analysis are more important. This summary highlights how each type of analysis contributes differently to decision-making, depending on the investor's objectives and time horizon. As we have seen, each type of analysis has its place according to the goals and investment horizon. For those trading short-term, technical analysis is key. For those seeking solid long-term investments, fundamental analysis is essential. And always, understanding the macroeconomic context allows us to decide where and when to invest. In our next class, we'll dive deeper into the fundamentals of macroeconomics and how they influence the stock market. Don't miss it. And if you found this content useful, make sure to subscribe to the channel and hit the notification bell so you don't miss any of our upcoming lessons. See you in the next class.